right, welcome to Knowledge Lane. So the topic I want to cover today is interest arbitrage. Okay, before we talk more about the interest arbitrage, let's just first understand what an arbitrage is. So an arbitrage is kind of an opportunity that arises when there is a mispricing between variables which allow traders to earn risk-free profits. Kind of a situation in the market where an investor can simultaneously buy and sell the same assets in different markets at different prices, allowing them to profit from pricing discrepancy, right? Essentially making a risk-free profit by exploiting kind of a temporary, market inefficiencies. Just to give you an example, let's say we have, a local store where I can buy a smartphone case, for $10, and I find that the same, smartphone case being sold on Amazon for $20. So I'm going to buy $10 from the local store, sell it for on Amazon for $20 a piece, and then for 10 cases I can make $100 in profit. Now, such pricing discrepancy doesn't last long, and soon we will have an equilibrium price. So there are many different types of arbitrage. The one in interest today is the covered interest arbitrage. That's what we're going to be looking into today. So in a covered interest arbitrage, you exploit favorable interest rate differences between two currencies, right? So you buy one currency at a cheaper rate and convert and invest into another currency which has higher yield, and you hedge the exchange rate risk through a forward currency contract. Okay. Now we can look into an example. It's going to make more sense. So here we have a given data about the spot rate, euro over USD 110. In other words, so for every €1 you want to buy, it's going to cost you $1.10 US. Okay. Now the spot rate is nothing but the current price at which a commodity, security, or a currency that can be bought or sold for immediate delivery. It's nothing but just the current market price. Okay. So spot rate, EUR over USD 110. Also, we have 1 year interest rate in Eurozone. Let's say it's 3%. We have 1 year interest rate in US, 5%. We have 1 year forward exchange rate between EUR and USD is 1.07. Okay. Now, we'll talk more about no arbitrage pricing here in a minute. But no arbitrage pricing in this case will be 1.08. So as you can see, it's different, from the 1 year forward exchange rate, which is 1.07. So we're going to exchange, euro over USD at this rate, but the actual no arbitrage pricing is 1.08. So what is no arbitrage pricing? So it's a price that prevents any risk-free profit from trading assets. So given the information we have about the spot and the interest rates, 1 year forward exchange rate should be 1.08. This is a no arbitrage forward rate, but for the sake of this example, let's say we have 1 year forward rate of 1.07, which will create an arbitrage opportunity. So let's take an example. So I have copied over the data here, and we can look into step-by-step arbitrage process. So let's say we are at time t equals to 0. So the first step will be we're going to borrow pounds. We're going to borrow euros, 1,000 euros, at a lower interest rate, which is 3%. So we are borrowing 1,000 euros at 3%. Now, so the plus sign indicates we have 1,000 euros in our bank account. The second step will be we're going to convert euro to USD at a current spot rate, again, which is 1.10. So we're going to sell euro and we're going to buy USD. Okay. So because we're going to sell euro, it's negative, so it's just gone away from our account. And then we bought USD, which is 1,100. That's how much USD we're going to get by converting 1,000 euros. The third step will be we're gonna invest US dollars at 5%. So 1,100 that's gone. We just gave it to the bank. It's gonna be invested at 5%. And then the fourth step will be at the same time, at time t equals to 0, we're gonna long forward contract, or we're gonna buy a forward contract EUR over USD, meaning we're gonna buy euro back, we're gonna sell USD. So after 1 year, once it matures, we're gonna sell the USD, we're gonna buy back the euros at 1.07, which is our forward rate. Because remember, we borrowed the euros, so we need to return those euros back, right? So at time t equals to 1, you get your US investment back. So we invested 1,100 US dollars at 5%. So after 1 year, or t equals to 1, we're gonna get 1,155. At the same time, remember, we long forward contract where we said, we're gonna buy euros, we're gonna sell US dollars at 1.07. So that's gonna give, 1,155. That's gonna be minus, which is left from our account, and then we have exchanged to euros, so we have plus 1,079.44 euros now in our accounts. That's the plus sign. Now we need to repay our euro loan at 3%. Remember, we bought, we borrowed euros at 3%. So 30 euros will be the interest we need to pay. So the total will be 1,030 is our loan that we're gonna repay, and then the risk-free profit will be 49.44 euros. Okay, so that's about it. Also remember, the currency with the higher interest rate will always trade at a discount in a forward market. Okay, so the currency with the higher rate, which is US dollars, with 5%, will always trade at a discount in the forward market. So our no arbitrage pricing was F equals to 1.08, which is less than the spot rate of 110. So it's trading at a discount. So that's about it. Share your thoughts and ask any questions that you may have in the comment section below. Again, thanks for watching. See you next time.